I found an obvious place for us to begin. This afternoon, the Fed reports its statement on monetary policy. What do you hope to hear from the central bank?
I think it's going to be very similar to their last statements in January. I think conditions have deteriorated since December, but improved since their last statement last month. I think they're worried about corporate earnings. I think they're seeing a real slowdown with U.S. companies. You still have the global uncertainties. You have uncertainties of Brexit. So I think they're going to be on pause, and they're going to wait and see what happens in the world and how our economy plays out.
Are you worried about corporate earnings?
Well, I think corporate earnings have shown a pronounced weakness, and I don't think it should be a surprise. We had a huge slowdown the first 2 months of the year. A lot of fear, a lot of consumers pulled back. We have an election here in this country where I think there's more fear-mongering than talking about hope and a renewed future. So I think consumers will pull back, and I think it's evident the economy grew at 0.6 or 0.8% after a very anemic fourth quarter. So I think it's all playing out that the economy is just not growing as fast as we expected, as fast as the Fed expected. So they're going to be on pause until they see an elevated increase in the economy and an elevated increase in corporate earnings.
Well, let's talk about that for a moment. The dots, right? The dot plot tells us that the FOMC still plans to raise rates by 50 basis points this year. The market, according to Fed Funds Futures, tells us that we're only going to see one 25 basis point hike. Jamie Dimon, for what it's worth, says he's worried that the Fed is going to have to raise rates too quickly to catch up with inflation. What do you think?
I think there's pockets of inflation, especially in the high-tech wage area. But I think around that, there's very little inflation. Obviously, we've seen an increase in energy prices from the various deep lows. I don't see any evidence at this moment for inflation. But I could paint a scenario why inflation will pick up in 2017, but I don't think that's an issue for 2016. And they have essentially another 7 months to determine that path. I would probably be in the camp of 25 at best this year.
At best, and possibly flat.
Yeah, I would probably lean more towards a 25 basis point increase. Let's see what happens with the Spanish elections in June, the Brexit elections in June, how the U.S. economy performs in the second quarter. And importantly, what is a consumer's mood into the primaries and after the primaries? There'll be plenty of time for the Fed to act. I think it is appropriate for them to be on pause.
Is the inflationary scenario you see for 2017 the odds-on scenario? Because as you know, the biggest private equity firms, I'm talking about Blackstone, KKR,
yes.
Carlyle, are predicting a recession within the next 2 years. A recession doesn't usually come with inflation.
I think there's two very binary outcomes, and I don't know what path that will be. I believe, and I've been saying this quite a bit worldwide recently, I believe what is happening in Spain with the lack of government since the elections in November, and they're going to push now the new elections in June, so there's not really any real government there. You have the fear of Brexit in the UK. We have the phenomenon of new party leaders in the United States with Donald Trump and Bernie Sanders, and I think all of this is an issue around how many people in these democracies feel like they've been left behind, and they're worried about their children's future. So I believe all of these elements, this political instability, is going to force whoever is the leaders of Spain, the UK, and the United States. We're going to see probably greater emphasis towards fiscal policy. And I think this is going to be key. And if there was a major increase in fiscal policy, and I do believe if the candidates in the United States are Trump and Clinton, I think both candidates will be talking about fiscal policy stimulus, in the form of infrastructure spending.
The problem, of course, is that most of the people who support these candidates whom you speak of, whether it be here or in Europe, want the government to spend more money. If we were to look at the debt to GDP levels in places like France or in places like Spain, spending, here's a chart, spending more money isn't really an option, is it?
Well, France, definitely, it's progressively getting worse. Spain, no. But in the UK, with its economy, and the US, if you spent it in infrastructure, that will be front-loaded at expense, but in the back end, it does produce positive GDP. If you're creating jobs, creating better and more efficient grid, better efficient roads, ports, airports. So you can get a mileage out of it. So I believe that's what we need in this country, and I believe every politician is going to have to address this uncertainty, this political uncertainty of, we have to ask ourselves, why are we seeing these phenomenons in so many countries? And I think that is going to be the narrative after the primaries.
And I'm speaking with BlackRock's chairman and CEO, Larry Fink. Larry, you were just telling me how you see the economy evolving. And frankly, it's not a pretty picture. But there's this silver lining that you're talking about, fiscal policy. Here's what I would like to know. If the economy is growing at 2% or less, and that's what the Fed tells us, and that's what pretty much everybody else tells us, how constructive can you be in the stock market?
If we see a path towards more fiscal policy and more investing in infrastructure going into 2017, we could see a second leg of the rally in equities. We could see monetary policy changing rapidly. And if that's the case, you would see rising rates faster than we forecast. We would have industries that probably have underperformed, outperform. You would have bank stocks doing very well in that scenario. You would have many of the commodity companies that have done very poorly, especially the cement and all those types of for manufacturing and infrastructure investing. You'll see those types of industries doing much better.
That's a big if, though. What if it doesn't happen?
If we continue to have what I would call a dependency on monetary policy worldwide, I think it's very grim.
What is grim?
Well, grim is we're harming savers worldwide with low and negative interest rates.
You've been speaking out about this.
Well, I think we forgot why people save. They save for their rainy day. They save for events, the events of buying a house, the events of their children's advanced educations. They save for events like retirement. When you have low or negative interest rates, it forces you to save more to get to that necessary pool of assets you need in retirement. And I think monetary policy was meant to be a 2 to 3 year gap to bridge the economies, and they did. I think the central banks were very courageous, but I think for governments to be so dependent on monetary policy as the sole means to stimulate the economy, to rebuild the economy, especially at a time when technology is advancing more rapidly, it is destroying jobs very rapidly. In our country, we're using the mantra that it's global trade that's doing it. It's more technology than just global trade.
So let's put some numbers to grim. What's the bear case? If we don't get this fiscal injection, if we don't get this infrastructure spending, what happens to the stock market? What happens to treasuries, which are now, 190 on the 10-year?
Yes.
What happens to credit spreads?
We'll have a very anemic to declining equity markets. It doesn't.
Will we have a recession?
We may, if we see more fear, more hoarding of cash. I mean, I think the biggest surprise by central banks is they talk about hoarding of cash. I don't call that hoarding of cash. I call it saving because they need to save more because of low and negative interest rates. We need to understand that the psychology of retirees, and we have aging population, the psychology of people who are near retirement is fear that they're not earning enough to meet the needs of their lifestyle that they so desire.
You believe, though, that this fiscal injection is coming. So when you mention bank stocks, is that where you see the greatest value in the market?
Well, I think bank stocks, especially the banks that are trading 0.6, 0.7 of tangible book.
The Citigroups, the B of A's.
The Barclays. I mean, we could go across the world and select some stocks.
The Deutsches.
So I think if we had that type of stimulus that I'm talking about, we would have the central banks could take their foot off the pedal. It would mean they could modestly raise rates, maybe at a more accelerated rate, and that would be very good for savers, would be very good for financial institutions' earnings, very good for insurance companies to offer annuities again.
But that's not happening right now.
No, it's not.
So tonight, right, Mr. Kuroda and the Bank of Japan are meeting. What on earth does he do? Because the last time he doubled down in January, going negative.
It was a mistake.
Right?
It was
the yen strengthened. The Nikkei sold off 13%.
It was an outright mistake. And that was one of my points of information that gave me this change of views related to fiscal policy. Monetary policy has run out of runway. And
so when he tells the government we could still go to
keep in mind,
half a point negative?
But keep in mind, Abenomics hasn't even begun. We talk about Abenomics, and we talk about the 3 arrows in Japan. Abe has not even begun his 3rd arrow, and that was the whole process of what Japan was trying to do was re-stimulate the economy through aggressive monetary policy. But the second phase, the 3rd arrow...
Right, but if you're Kuroda, what option do you have right now?
Kuroda has to go talk to the Prime Minister and say, I ran out of runway. I think it's evident he ran out of runway. Negative rates is...
So, in other words, Bank of Japan monetary policy no longer works, in your opinion?
I think it has not worked recently, and I think it's going to continue to not work. And Japan is a great example. I mean, we should be looking at what happened in Japan. Japan is a nation of savers. Most of the savings are in bonds. And as a result of that, the savers are now saving more. They're pulling back. Consumption has not met all the forecasts in Japan. And it's a fact because the consumers in Japan are pulling back. At the same time, Japan's benefiting by all the Chinese who are coming there for tourists and buying food and other items. And still, Japan looks like it's going to be zero, economy with zero GDP. So it's failing.
What about China then? If it's these Chinese tourists who are coming to Japan, Japan may be benefiting from that.
China is putting their foot on the pedal as fast as any economy right now. China, I think, and I've been to China twice so far this year, I think I think the Chinese leaders have done a better job in trying to reboot its economy than most leaders of the world. We're in the 4th year of the Xi government 10-year plan. It is about reorienting the economy from moving it away from an export manufacturing economy to a domestic service-oriented economy. Unfortunately, that takes tens of years, and it's not without many hiccups. And it looked like there was going to be a major hiccup, and there was some very bad communication of the Chinese, which led to the market fall in January and February. I think they restabilized their effort related to their messaging, and I do believe what they're doing now is doing very aggressive monetary policy in China right now. The banks are lending at a rate that they haven't done before. So indeed, in 2016, China is going to look way beyond what we thought it would look like economically, GDP-wise, in 2016. It may mean the bubble's bigger for 17 and 18, but in this year, especially in light the Chinese are the host of the G20 in September, they're going to want to make sure that their economy is a beacon of strength, not a beacon of...
The bigger the bubble, the bigger the burst, though. Aren't you afraid of that?
It could happen.
It could happen.
It could happen. I would, first of all, the economy's still growing at 6-ish%.
Right.
It could, when you grow at that rate, you can navigate out of this problem if the next phase of growth is not by ballooning balance sheet.
But if not, you get the bubble bursting, and I'm sure you've seen the estimates that if that were to happen, given the levels of bad debt already on bank balance sheets in China, that the losses in the Chinese financial system could be 4x what they were for U.S. banks during the subprime crisis. Do you believe that?
Well, I don't know if it's that large, but I do, I think many of our hedge funds believed it was going to be an event in 2016. They're going to need to devalue. And I went out publicly saying that's not going to happen, and it's not going to happen in 2016. Am I worried about in the manner in which they're accelerating their economy? Yes. Does it mean there's more potential for a bubble and a burst? Yes. But it may not happen if they navigate this, if they reorient, if you see more.
What do you think the odds are?
20%.
20% that the bubble bursts. So 80% that China makes it.
Yeah, but I don't like the 20%. Yeah, but I think in 2016 you're going to look back and said, I wish I was in China.
Really?
I think the equity market will do fine this year. I'm not telling you. I'm not telling you it's a great long-term trade.
Larry, we talked earlier about political extremism and how it's driving leaders and candidates to make certain decisions and take certain positions. It's been a tradition in this country for presidents to reappoint Fed chairman, even if there's been a change of party in the White House. Reagan did it for Volcker. Clinton did it twice for Greenspan. What's going to happen if there's a Republican in the White House? Is Janet Yellen going to get kicked out?
I don't know. I haven't thought about that.
What if she did? Would that be bad for markets? Would that be bad for the economy?
It may be bad. It depends on who would be the replacement, the degree and how this is being messaged.
But for the sake of stability, that's why it was done before.
It would probably be thought of as bad. Keep in mind, the transition from Greenspan to Bernanke was considered a frightening moment, and then from Bernanke to Yellen. It generally, if you get a qualified chairperson, he'll end up being fine. And I think Janet Yellen has been a fantastic.
One more quickly, Larry, before I run out of time.
Yeah.
Given the climate and what we've heard from the candidates, can any president right now, Republican or Democrat, pick a Treasury Secretary from finance or Wall Street?
I would hope whoever is the president, they pick the most qualified person, whether it's finance, manufacturing, or somebody who has a long career in government. We need leadership more than ever to guide our nation forward.